How do I calculate the monthly rate, the premium rate for the displaced family to stay in my furnished accommodation? That is probably one of the number one questions that I get. And the good news is that there is a science to it. And the science is doing the math and understanding how that works. But now, before we get there, I want to give you a rule of thumb so you can do the behind the napkin kind of math. And that's why we'll do it. I'll do it on the whiteboard. How's that, right? So there is a method to this madness. And if you're new to this concept, the concept is that when a tree falls on a home, you have a tree that falls on the home. You have people who live in the home who are also called homeowners or policyholders, not to be mistaken by investors, right? These are people who have an insurance policy that's associated with their mortgage, right? Every mortgage company is going to, I don't like to use the word force, but recommend that force, because they're giving you a loan and they expect the house to be insured, and therefore that is why you pay a premium every single month or annually, right? And so when you are a policyholder and something happens to your home, there is on your policy a line item that says coverage A and coverage D, right? Coverage A is the dwelling value. So how much is this home worth? So for the interest of keeping numbers simple, as this home is worth 400K, right? And when this home is worth 400K, the dwelling, let's keep a few things in mind here. Maybe the dwelling value is, for the interest, 300K. It means it costs $300,000 to build that home, and you essentially paid 100K for the land, right? Which then means, let's say, coverage D. Why is coverage D important? I have another video on this channel that talks about the importance of coverage D. Coverage D is also known as three things. One, loss of use. Two, additional living expenses, also known as ALE, right? And three, well, coverage D. So it's 1, 2, 3. It's going to be one of those three that you see on there. Loss of use, additional living expenses, or coverage D. Those are the main areas that you need to know to allow to do this math. Now I'm going to keep things super simple here, right? Because we talked about coverage A, which is the dwelling value, and we talked about coverage D. So how does it all come together? Just watch. What happens is, if you're currently getting value from watching this video, you'll want to make sure you take a second and click below to grab the midterm rental insurance blueprint to help accelerate your process in being able to land these midterm rental insurance contracts with respect to your marketplace. Make sure you click the button below and grab it, and continue on with the gems in this video. In order for you to calculate what you can charge a family that's displaced into your home, remember this family is here, call it a family of 5. There's 5 of them, got a little dog as well. Family of 5 is in your neighborhood, comes from a home that's worth $400,000, right? Now you're saying, Ruben, how does this work, right? If I have a home and it's an Airbnb today, but I also want to get into this midterm rental insurance opportunity, what do I charge, right? Question mark. What do I charge? Well, here's the math. You ready? If you want to do the napkin math, you take 400K and you multiply it by 0.20. That's 20%. Rule of thumb, anywhere from 20% to 30% gets you what we call, what we just covered, and I'm going to do some public math here, which is a high risk. Doing public math, there is nothing like doing public math, y'all. It is stressful. Just kidding. $80,000. $80,000 is the equivalent of what we talked about before. It's, remember, coverage D. I'll put it here below, coverage D. So $80,000, most of the time, the rule of thumb is a 20% rule. I have another video that I recorded called the 20% rule. So 20% of the home's value can get you the equivalent of what we called loss of use, additional living expense, aka coverage D. Now, Ruben, what do I do with this 80,000? What does that mean? It means that if something should happen to a family from a $400,000 property that's similar to your home, it would not be unreasonable for you to charge. You do $80,000 divided by, let's say the family needs to relocate for 6 months. You divide that by 6. That's $13,333 per month. It would not be unheard of for you to be able to confidently charge $13,333 a month for a fully furnished home with utilities on, all amenities included, to house a family of 5 with 2 dogs, or a dog and a cat, right? That's what this means, right? But now you might say, well, Ruben, what if they stay longer than 8 months? Well, they have $80,000 to play with. So maybe, if you will, it would be 13,000 times, what did I say? 8 months? That's, you do $80,000 divided by 12, let's say. You get 6,606. You can even multiply that by 8. And it would not be unreasonable for you to be able to charge $53,000 for the next 8 months. Now, it all depends the length of the time. What we're saying is we have $80,000 to play with to divide out based on the amount of time that's going to take to relocate that family. That's why the insurance company is not going to want to overspend their budget, right? So therefore, they're going to come to an agreement that gives some breathing room, because we don't know how long the construction work is going to take. Now, how does that tie back into the coverage A? Well, this is napkin math. So in short, if you're wondering, Ruben, how do I price my property? Remember, a family that's going to come to your property is coming to a very similar property that they're coming from. They're calling it a like property. I was just on the phone with a relocation specialist less than 24 hours ago. We're going over the criteria. That's exactly what it is. It's a like property. If you're living in a $400,000 home and they got to relocate you, they're not going to relocate you into $1 million home. They're going to find a very similar like property to relocate you to. For that reason, this is why it actually serves us to know the kind of property that we have and how much it's worth. And if you own, manage, co-host your property, you should know how much it's worth. Even if you don't have access to the insurance policy, because maybe you don't have access to it because you can't find it, or maybe perhaps you're actually not the owner, you're a property manager, doesn't matter. You have an idea, you have a ballpark. Now, if you want to get super granular and you have access to your policy, there's going to be a thing there called a dwelling unit value, which is not too far off from the property's worth, but I'll tell you why it plays a key major role, right? The dwelling, which is coverage A, the 20 to 30% technically is actually of coverage A, right? And because we're saying we don't have access to a bunch of the policy holders, the $400,000, the price of the home is close enough. But if you want to get super granular, for example, coverage A on this property, the dwelling value could easily be, let's say, $300,000. Let's call it $350,000, right? Maybe you pay $50,000 for the land, $350,000 is the cost of the dwelling value. You take 20% of that, that's now $70,000. But now keep in mind, 20% is just a rule of thumb. It goes anywhere from 20 to 30% sometimes, which means that if I took 30% of the dwelling value of $350,000, right? So that's $350,000. You go here, want to get more granular, we can get granular. $350K, right? Times 0.3, because now we're saying, let's say it's 30%, right? That's $105,000. Let me do that one more time just so I know that that's accurate. Times 0.3. That's $105,000. The loss of use now is $105,000. If you run that at 0.20% of 350 of the dwelling value, because that's really the true and closest formula, and you can see if you look up here, I'll have the video pop up and show you one of the insurance policy. So you can see here, one is 20%, another is 30%, right? And that's more or less the sweet spot, right? So 350,000 times 0.20, that's now 70,000. So you can see it's a big jump, right? But anyway, it ranges, right? So your policies are going to range anywhere from 20 to 30% of coverage. If you don't have coverage A, do the napkin math and go based on the value that you see on Zillow. Just keep in mind, especially for those who are in very expensive markets, keep in mind that a home, let's say, call it good old California that we love so much, never rains in Southern California, right? Let's say you got $1 million home and you paid $1 million for, just keep in mind that who knows, there's a good chance that maybe the house is actually worth, I don't know, the dwelling value is 500K, right? And the land value is 500K, right? Land versus dwelling. So keep in mind that don't just take the 20% rule and run away with it, especially in an area where you know land is very expensive. Try to get as close as you can, and there's you can still look on Zillow for land values and stuff like that. But just keep in mind that the insurance company is going to go by the dwelling value, 20% of that value. So that is the rule of thumb. Once you do the math, you actually now have a denominator that you can work with so that you can actually comfortably, if you want to be as conservative as possible, take that loss of use, right? Additional living expenses or coverage D amount that you've calculated after you've done the 20% of the dwelling and or price of the home, and take that value and divide it by 12 to, that's like the lowest you should go, right? But if you want to run it up, you can run it up. And by run it up, if you want to charge a premium, then what I would do is then take that amount and even divide it by 6, half of the year. That's very typical, by the way, for them to start for 1 month booking, but then to want to extend over and over again because it takes a while. So it actually serves you to charge a premium, but you want to make sure the premium is well within the means of the actual amount that would actually be allowed or that they'd be eligible for on their policy. Now, because there's a lot of nuances that I just talked about, keep in mind some insurance companies do 20% of the dwelling value. Some do 30%, so it might be more or less around that ballpark. But keep in mind that it's all on a case by case basis. Why? Well, what if this family with the tree and of course the lovely dog and cat, which now my dog needs to be reconfigured. Let's say this family's been looking around, like the tree fell in their home, they can't live there. It's going to take 6 months, right, to rehab, and they're looking around in their neighborhood and no properties are available. Well, this is why it actually serves us to be available, because once the inventory is not available to relocate a family of 5 with 2 dogs and it's actually not worth it for them to go to a hotel, but they are there temporarily, you now become what I call the prize. Because my question that I always like to say is, what is the alternative of you not being able to find another option? Which means when there's a low supply, guess what happens when there's a low supply? The price goes up, which means that I can definitely charge on the more aggressive side, because the truth is there's no inventory. And we know this because even we know some of the number one temporary relocation company in the nation, and multiple of them have gone to unfurnished rentals because there's that. And when I say unfurnished rentals, they're adding that to their inventory of properties that they're trying to source, because there's just not enough furnished accommodations available. And we all know that a furnished accommodation is actually just a better experience for everybody, because they don't have to do anything by like turn on utilities or anything like that. Home's already furnished, they come off, they sign off, you sign the contract, and everybody gets paid. Okay, so this is the math behind it. It's the 20% rule. If you haven't watched one of my shorter videos, watch the 20% rule video and why it's important, why it matters. And now I've given you guys the blueprint on how you can actually price or reverse engineer a price, keeping in mind there's a lot of nuances. And what I like to do is always go back to the source. Ask how long they're anticipating to stay, what was the damage, what area, zip code they came from, because all that data, how many bedrooms in the home, what zip code, what city, what do they need to be in proximity and close to, because the more you have data on this, the more it allows you to reverse engineer your price so that you can maximize the amount of dollars, because we're not just charging people here. Your house becomes an asset. Your furnished accommodation becomes an asset when you're solving a larger problem. And I always say that you get compensated based on the size of the problems that you solve. If I helped you solve a question that was a kind of aching question that you've been dying to answer, the only thing that I ask is subscribe, because you'll get more answers by being able to follow this channel. And feel free to grab the midterm rental insurance blueprint on my website as well. More value to you, More power to you. Happy stay.